Each range is a PD array hierarchy. And once you know how to incorporate that into your analysis, once you learn how to incorporate that into your strategy, then you're going to have a high probability of finding success. What are PD arrays? PD arrays are institutional reference points that signal a potential shift in buying and selling activity. The PD array matrix is a hierarchy that provides a structured approach to analyzing price movements and forming directional biases based on key price levels. Price moves from discount to premium, premium to discount, using PD arrays. So for price to move from the downside going to the upside, it requires PD arrays, or it uses PD arrays. Price finds support on PD arrays. It finds resistance on PD arrays. Price creates each and every level in the market based on what PD arrays tell it needs to happen. Am I making sense? In simpler terms, price cannot move from premium or discount without engaging PD arrays. So this is what I mean when I say PD arrays are the foundation or the backbone of the market itself, right? So imagine you know nothing about PD arrays and you start trading today. That means you're going to be trading from an incorrect analysis, and mind you, you might get lucky, right? Because the market, you only have two options, either buy or sell. So it's not hard to make money. What is hard is keeping it, and the only way you can keep it is if you can trade consistently while making profits, right? If you trade consistently and you're losing, then you're gambling type shit. If you want to be profitable, you need a profitable strategy. PD arrays are identified as discount arrays when price is below equilibrium, and premium arrays when price is above equilibrium. So imagine this is a price range, right? We have 3 stages or 3 levels within each and every price range. We have the discount, we have equilibrium, and we have premium. This is the foundation or the basic structure of what we are going to be looking into. A list of the only PD arrays you need, and the order is as follows. The mitigation block is the first PD array, which is the closest to the equilibrium, as you can see illustrated in this diagram. Then we have the breaker block, which comes after the mitigation. Fair value gap, third. Fourth, we have the order block. And then the fifth, last but not least, we have the liquidity pool. And basically, the liquidity pool is either sell side liquidity or buy side liquidity, right? So these are the main PD arrays, and each PD array has its own variation, maybe 1 or 2, 3 variations. For example, we have the fair value gap, and a variation of a fair value gap would be an inverse fair value gap. So now we dive deeper into each and every PD array. The first PD array, a mitigation block. This is a form of smart money order mitigation, meaning this is what creates what is known to many as support and resistance. We see price came down, went up, came down again, but it failed to break this low and continued higher. So the highest point between the two lows, that candle in between that is the mitigation block. And you see price broke out, came back inside, retested, and then started impulsing higher. Mitigation blocks provide an opportunity for smart money to mitigate potential losses or drawdown. It is important to understand the distinction between mitigation blocks and order blocks, as the latter does not mitigate. It says order blocks right here, but I meant to say there's a distinction between mitigation blocks and breaker blocks. Breaker block. A breaker block is essentially a mitigation block that takes out liquidity. This is the same as ICT's breaker swing. You see, the breaker block takes place exactly where the mitigation block forms, right? But the only difference is that on a mitigation block, the lowest low is not taken out by the subsequent low. So this is a failure swing. But on a breaker block, the lowest low took out a previous low. Breaker blocks and mitigation blocks are both forms of order mitigation. A breaker block takes out liquidity and a mitigation block does not. Easy. Here is an illustration of the two PD arrays side by side. Breaker, it's in the name. Breaker. Mitigation block, price creates a high, comes down, goes higher, fails to take out the previous high, reverses from right here, goes down. These two PD arrays basically perform the same function. The only difference is in their formation and their names. A fair value gap is an imbalance or an inefficiency in price created when one side of the market is offered aggressively. Fair value gaps are the spaces that are created when price impulses aggressively in one direction. In this example, we can see price impulsing to the downside. The space in between the two candles that create the gap is what we refer to as a fair value gap. This is a bearish example. This is a bullish example. Very easy to understand. Order blocks represent a change in the state of delivery in the market. In the context of a bullish order block, it is defined as the lowest candle or price bar with a down close that has the most range between open to close and is near a support level. So imagine price was crashing before this price action right here. Imagine price was crashing, right? The last candle that is in line with the previous order flow is what we refer to as an order block. So this candle can be in the form of a full engulfing candle such as this one, or it could be a spinning top or a doji or any of those other. The candle that we refer to as an order block has to have the highest or the most range between the open and the close, meaning the main body. So if this was a doji candle, if the body was a tiny body, we wouldn't refer to it as an order block. We would look at the candle before that, and if it had the full body like this one right here, that is what we would refer to as an order block. And by the way, these PD arrays are not meant to be utilized on their own, or they're not meant to be used by themselves. You have to pair these PD arrays with other confluences of your strategy, and that raises the probability of success in your method. You could use the high of the candle, or you could use the open as your entry, right? If price reversed from this candle going down, this would be the order block. We would use the open of the candlestick right there, then we would go short. With most of these PD arrays, the way we utilize them is by waiting for a break of structure and then waiting for the retest on the PD array. I don't know if that makes sense, but if you know, you know. Still on order blocks, not every up or down close candle qualifies as an order block. Once price started pushing higher, it came back down and retested the order block. A propulsion block is an order block that retests a valid order block. So this is the valid order block in here, and the propulsion block is the order block that retests the main order block. Once price retests this order block and it starts to impulse higher, next we're interested in the propulsion block. And if price doesn't come to the propulsion block, then we would use this fair value gap between this candlestick and this candlestick. The space in between that is the fair value gap. We would have our entry right there. If we enter down here, then we would use the subsequent PD arrays in here as our scaling areas or scaling points. Very easy. Liquidity pools. These are areas in the market where there is a concentration of buy or sell orders resting above or below, as illustrated in this diagram. We have sell-side liquidity right here. So sell-side liquidity comes in two forms. It could be the level that is created by two swings or a single swing. So if we have two relative equal lows, then that is sell-side liquidity. If we have two relative equal highs, that is buy-side liquidity. If we have a single high or a single swing, that is still buy-side liquidity. If we have a single swing low, that is sell-side liquidity, as illustrated in this diagram right here. So we have these relative equal lows, that is a liquidity pool. We have this single high right here, that is a liquidity pool. Relative equal highs right here, relative equal lows right there, relative equal highs once price comes back up and retests the level right there. So each and every swing in the market is a liquidity pool. Remember that. The only differentiation between the liquidity pools is the number of times price retests that area. Retail traders see these levels as strong support or strong resistance. Therefore, they put their stop losses below the level, or put their sell orders below the level, or put their stop losses above the level, or put their buy stops above the level. And price or smart money loves this because it knows there's liquidity above there or below here, and it's going to purge those levels. That is why they're referred to as liquidity pools, because price is still coming back for those levels and liquidating them. The PD array matrix is a hierarchy of institutional reference points. With this, we can create a narrative around price and trade off these higher time frame PD arrays in the direction of the draw on liquidity. Each PD array within a dealing range can be viewed as a single line of defense for price. The best way to use these PD arrays is to mark them out on a higher time frame first, right? And once price comes into these levels or this higher time frame PD array, then we drop down to the lower time frame and look for market maker models to use as our entry confirmations. Each range has discount, premium, and the equilibrium. So this range has its own PD array hierarchy. This range has its own PD array hierarchy. This range has its own PD array hierarchy. So each range is a PD array hierarchy. And once you know how to incorporate that into your analysis, once you learn how to incorporate that into your strategy, then you're going to have a high probability of finding success. You can check out the other videos on my channel as I delve deeper into the different ICT concepts. It's your boy OMG Pips. Don't forget to smash that like button, hit subscribe, and turn on post notifications so that you're notified each time I post a new video. Let's get it.
And remember, in forex we're talking about, we came in this game for money. We came in this game to earn a living. So we are not here to play games.